Right, I'm not sure how I'm going to do this week as I'm whizzing up and down the UK, 3 different days, 3 different hotels. On top of all that, I'm going to be desperately trying to get home on Friday night for bonfire night, so let's give it a try anyway. So hopefully in this video I'll get to share my thoughts on why your Vanguard portfolio might be performing a little bit better than the media says it is, discuss what impact Tina is having on the markets and realistically what can you do about it, and of course seeing how my own Vanguard portfolio has gotten on over the last month, and maybe finishing off where I think I'll likely be over the next year. Right, I better get a move on. I've got a hotel to get to. So, if you hold any sort of Vanguard fund, then you've likely had a fantastic year so far. Global All Cap is up 23%, Life Strategy 100 up 23.5%, and my very own FTSE All-World up 27%. But if you listen to the media from all sources, you'll likely hear that the market is being supported by the Fed and other governments around the world. Don't get me wrong, this is having an impact, but if you look into the detail, then the bubble hasn't got any bigger, or much bigger at least, since the start of the year. The S&P 500's P/E ratio, so the price of the S&P 500, then compared against its earnings, since the start of this year has moved from 36 to 34, meaning it's actually slightly cheaper. Based on this, you could easily argue that valuations haven't become any more stretched over the last year, and based on this, your gains this year are true market gains, in the form that businesses are becoming more profitable, rather than more shorter-term pumps by the government. This data isn't backed up by the S&P 500 as denominated by gold though. So in brief, how much gold would it take to buy the S&P 500? So far this year, it's moved from 2 to 2.4%, meaning if you wanted to buy the S&P 500 now, it would cost you 2.4 ounces of gold instead of 2, a 20% increase. But this isn't as straightforward as a P ratio, as gold typically acts as a fear index and moves in the opposite direction to the stock market. Well, in theory at least. But it does give you a steer on the markets as gold builds in inflation, where fiat alone does not. We need to put these gains into a broader context. It is still true that these are the most stretched valuations we've seen since the dot-com bubble, and far higher than any other period other than that. Actually double the long-term average, in fact. But you might be sat there thinking, oh my god, if we're double the long-term average, is there a level of certainty that we'll actually go back to that long-term average, meaning that all our portfolios will get a 50% haircut? Well, it's not a straightforward answer, and it's getting a bit late now. It's 11:15, so I'm going to get to bed, but I'll see you in 24 hours, or in your world, probably a few seconds. See you then. Right, where were we? Yeah, there we go. So, are we in for a 50% cut to our Vanguard portfolios? Well, the honest answer is, who knows? But personally, I think it's extremely unlikely. You need to remember that the long-term average goes all the way back to 1871, and a hell of a lot has changed in the last 150 years, which has completely changed the supply and demand model for the S&P 500. If you look at the trend, the S&P 500 has actually spent 95% of its time below the long-term average up until 1986. Since then, the reverse has actually happened, meaning that the long-term average is extremely skewed. If you look over the last 30 years, the average P/E ratio would have been around 24, so a good 50% higher than the 150-year long-term trend of just 16. This would put today's 34 at a 40% premium, rather than the previously stated 105% premium, a massive difference. This fact itself would put the hypothetical 50% haircut down to just under 30%, but 30% is still a good chunk though. I would go further to say that the data from just the last 30 years is also skewed, probably just as much as the last 150 years. Just think of the accessibility to the stock market we have today compared to that of 30 years ago in 1996. Do you think people in their 20s and 30s back then were buying stocks and shares in the numbers that we are today? Well, consider that buying stocks back then involved mainly filling out forms and having to travel to your local bank in person to do so. And then the only update you could get on your portfolio of stocks would be to buy the paper once a day and work it out for yourself. I will concede that the internet was around in 1996, but it was a complete shell of what it is today. I would go on a limb to say it was probably quicker to drive to your local bank instead of trying to connect to the internet and doing it that way. I think we can confidently say that there's a lot more uptake today than back then, meaning there's been increased demand but the same supply. But this is all very bullish, at least more bullish than the wider market is saying. So let me be a little bit more balanced and discuss why, in my opinion, we are likely going to see a underperformance over the next few years. It's hard to argue against the fact that share prices are currently being massively supported by historically low interest rates and equally historically high stimulus packages from all around the world. And this has caused TINA. No, not the Queen of Rock and Roll. TINA, which in our world stands for There Is No Alternative. As a bit of a history lesson, TINA is a phrase that was actually popularised by the then British Prime Minister Margaret Thatcher in the 1980s. But today, it's often used by investors to explain a less than ideal portfolio allocation, usually stocks, because any other alternatives on offer would have worse potential returns. This situation can lead to the TINA effect, where stocks only rise because investors really have no viable alternative. And this is where we are today. Realistically, where else would you put your money right now? In a savings account, maybe? Bonds? Whiskey? Right, now you're just being stupid. You could gamble on crypto, but really, if you have any money which you want to invest, then it's likely going into the stock market, no matter the price. There really isn't much else. Thus, there is no alternative. We've been on the TINA journey pretty much since the start of April last year, and it's only going to continue until interest rates rise or when governments stop purchasing assets and actually start to unwind their positions. When either or both of these start to happen, it will draw money out of the stock markets as there will be alternatives for investors to move to. It will have an effect on your portfolios if you only hold stocks and shares. Your only hope is that the companies that you own start to grow their bottom lines quicker than expected, so it softens the blow for when this actually happens. I actually only have one counter to this argument though. Are we ever going to get ourselves out of this low interest environment that we're currently in? And I do mean that seriously. Governments are now acting quicker than ever before to support the economy when any sort of turbulence is spotted, and it's creating a monster. It's creating an economy which is dependent on money printing and low interest rates. It will get to the point where our financial systems are fully addicted to this support. And anything counter to this would start withdrawal symptoms, which will likely look like the markets crashing. You might think long-term interest rates are a little far-fetched, but let me point you to Japan. They have had long-term interest rates and very little capital growth. Over the last 30 years, the Nikkei, the equivalent to the S&P 500, has only grown by 20%. In that same time period, the S&P 500 has grown by 1,110%. The only real winner I can see in the way the markets are going is actually going to be Bitcoin. Why, you might ask? Well, saving account interest rates are delivering below inflation at the moment and would stay that way with low interest rates. You wouldn't put money into bonds for exactly the same reason. And then for the vast majority of people out there, investing into shares and stocks is far too risky. As it stands right now, the only option would be really Bitcoin or gold. My preference would actually be Bitcoin with a mindset that it would be more stable in the future. And after all, gold doesn't have a finite supply. But at the end of the day, these are just my thoughts. I would love to know what you think. So, how has my Vanguard portfolio fared over the last month? Well, by judging by the share price by close of play today, I think it's going to be a pretty good one. But saying that, it's been an extremely long day, and if I'm going to do this part justice, then I need to get some sleep. So, I'll see you tomorrow in just 1 second. A new day, a new shirt, and a new hotel. Let's get into the good stuff. Right, how has my Vanguard portfolio gotten on over the last month? For anyone new to my portfolio, then this is all you need to know in just 12 seconds. I invest exclusively into the FTSE All-World, ticker symbol VWRL. I've been investing since the start of 2018, and my method of choice is lump sum investing, but I do use dollar cost averaging if I have a lot of cash on hand for some unlikely reason. We good? Good. If you have any further questions, then you know where the comment section is. And while you're there, why not show the like button some Tina? In terms of last month, the market pooped itself a little bit and brought VWRL down by 4% to £87. Not what you really want, but it's miles away from the pandemic bottom of just £55. In terms of my account balance, I was on a tidy total of £66,300, following a lump sum investment I had of £2,700 from a sale of some shares that I'd got then also my quarterly dividends on top. At that point, my profits since starting totaled over £15,000, so roughly the cost of a mini hatchback. Well, this month has been a bit of a surprise, as the market stuck two things up at anyone crying that it was going to be the start of 2008 again last month by rallying 4.6%, meaning that VWRL has broken the £90 mark for the first time, and that's amazing considering at the start of the year it was just £78. This has brought my total balance frustratingly close to £70,000 at £69,686, meaning that my 2 direct debits to go this year, I should break this 70k barrier by Christmas. But where do I think my portfolio is going to be in the next 12 months? Well, let's think about this logically. Firstly, how much am I planning on investing next year? Secondly, what is the most reasonable worst case scenario? And lastly, what's the best case scenario? Reasonably. Well, over the next 12 months, I'm really hoping I can finally max my ISO, which has been a bit of a medium-term goal for me. So investing £20,000 over 12 months. Right now, I'm investing between £12,000 to £14,000 a year, but I am due to pay off my student loan shortly, which will be releasing about £300 per month. And I'm also hoping that some of my side hustles might start making a little bit more money. So my use of Roma that you might know, obviously this YouTube channel, and then I've also got my side business, the K9 menu. So as a starter, let's add 20,000 to my current total. So let's just say 90,000. So what's a reasonable worst case scenario for the stock markets? Well, let's assume that the market will continue to grow at an average rate, so 7%. This will put us at £96,300. But on top of this, let's say that valuations then move down, like discussed before, to an average PE ratio of over the last 30 years. So the current 34 moving to 24. This will then give me a portfolio value at the end of next year just short of £68,000. If we took the same scenario and then stretched the PE ratio to match the dot-com bubble peak, meaning that the current ratio of 34 became 46, this would give me an account total of over £130,000. So realistically, my range of outcomes is somewhere between £68,000 to £130,000, with £96,000 being somewhere in the middle. Anyway, that's just some food for thought. Let me know what you think in the comment section below. If you've enjoyed this video, then it'd be highly likely that you enjoyed the video on the screen right now, which is all about why I believe that the Vanguard index funds will outperform all other investment platforms over the long term, including Hargreaves Lansdown. If not, then I'm going to get to bed and then I'm going to see if I can make my family bonfire night sometime tomorrow. If I have, then I'll probably get some footage in right now. Anyway, thanks for watching. See you in the next one.